Hi, this is Pat with Energy Solution Partners sharing with you our energy market view on Thursday, June 28th. Always keep in mind there is a risk of loss when trading commodity futures and options. Well, I want to spend my time today looking at the crude oil inventories and some of the things setting up in the crude market. A few interesting things that I'm seeing that I just want to point out and share with you. And our first slide, we're going to look at the stocks at Cushing, Oklahoma. And well, the overall inventories at this location are not real big compared to total U.S. stocks. It is a very important inventory point because this is the delivery location for the WTI crude contract. And if we look at stocks here at Cushing, we are at some low levels down in the 30 million barrel range. And if we look at where we were just a year ago, we have half the levels from where we were last year at this time. So pretty impressive drawdowns in the stocks at this Cushing, Oklahoma delivery point. Now, overall, U.S. crude inventory, we are sitting at 416 million barrels, which if we look over the previous 3 years, we're much lower than where we've been the previous 3 years. But at inventory levels quite a bit higher than we've seen earlier in the decade. But now if we look at the refinery utilization here in the U.S., in yesterday's inventory report, it showed refineries running at 97.5% capacity, and we have been running at these real high levels. And so with the refineries cranking out gasoline and diesel, it has been drawing these crude inventories down at a substantial rate. So if we take those high refinery runs along with the current crude inventory that we're sitting on, our days of supply is at 23.7%, which is lower than we've seen at this time of year. And at some low levels. In comparison, a year ago, our days supply of crude oil was at 29 days. So we have drawn that down substantially, and the fewer days of cushion that we have will create that much more volatility in that crude market. Now, if we look at U.S. crude production, and as everyone's aware, we've really ramped up our production in the U.S. And much of this being in the Permian Basin down in Texas. And if we look back in just 2 years' time here, we've increased our crude production in the U.S. by 2.5 million barrels per day, and over the last 12 months, it's increased about 1.5 million barrels per day. And so this is real impressive, and has made the U.S. a major world producer in crude oil. But the interesting note here, we've seen this production level off in the last 4 weeks of inventory reports here in this 10.9 million barrel per day range. And there's some thought that we are peaking in production in this Permian Basin for the short term anyway, until we can catch up with the pipelines that are needed to get this product out of that area. And with that, there is some thought that the producers will have to slow down their activities until they can get this product out of that basin. We did also see in last week's Baker Hughes drill rig numbers report that we actually decreased the drill rigs in the U.S. by 5, again indicating there's maybe less new production activity here for the short term anyway, until the pipelines can catch up to get this product moved. If we look at the forward curve in the crude oil market, and this is what impresses me most in today's market, the backwardation in this forward curve. And what this is showing you is today's crude contract, the front month is trading at about $73 a barrel. And if we look out 12 months out into July of 19, it's down in the $65 range. So that is a steep backward curve here. And what this is telling us is the market is paying up to take delivery today, and it is not paying to store oil. And with that, that's going to bring as much oil to market today because of the high price on the front end here. When we see this type of setup, it's typically a pretty bullish scenario. It tells us demand is very strong, and as long as we see this type of setup, I think we need to be thinking bullish on this market here, and it tells us demand is very strong. Now looking at the same forward curve, only in a different format. This is a chart taking the front month contract minus the crude contract 12 months out. And you can see how this structure has changed going back to September last year, where we had a $3 a barrel carry in this 12-month spread. And today, now we're at this $8 of backwardation. So that market structure has changed substantially here in a real short time, again, indicating very strong demand. And if we look in just this past week, we've seen this change by $5 a barrel. And much of this is tied to a disruption in Canadian oil production. There was a production facility in Canada that had some power issues, and it sounds like that facility may be down for 4 to 5 to 6 weeks. And that facility was producing 350,000 barrels of crude a day that is now offline. And so, with the loss of this Canadian production, the U.S. is the next closest producer, and again, the demand has it looks to increase here in the U.S. oil. So with those items in this forward curve, I think we have to be constructive on this market yet until we see this curve change. It just tells us demand is very impressive, and we continue to march higher. If you would like to visit on any of these items that I've shared today or talk about your needs here into the fall or winter months, please feel free to give us a call and we would sure like to visit with you. Thanks and have a great day.